Be your first speaker, and if Michael Williamson doesn't get here, I'll be your second speaker as well. So we're going to talk a little bit about the Wisconsin retirement system today. I'll talk about kind of the benefit side of things, and Michael, of course, will talk a little bit more about some of the investment things that are going on. But first, I thought it would be good to just kind of remind folks or introduce folks to who we are at ETF. So ETF, the Wisconsin Department of Employee Trust Funds, is the state agency that administers a number of fringe benefit programs for public employees in the state of Wisconsin. We are a non-cabinet agency, so that means I, as secretary, am not in the cabinet. I'm appointed by an independent board made up of a number of appointees, people who are elected directly by the membership, and appointed by some of these other boards that you see. We have about 266 full-time employees at ETF. All but 3 of them are in the classified civil service, so they have civil service protections. We have an annual operating budget of about $40 million. As I mentioned, we have a number of boards that we deal with. All of those boards are fiduciary boards. They have fiduciary responsibility to the members of the trust fund and to those benefit programs. The ETF board is kind of the oversight board. They appoint me, as I said. And then we have a number of other boards. The Group Insurance Board, and they are responsible primarily for the insurance programs that we operate, most notably the State Group Health Insurance Program. The Teachers Retirement Board, the Wisconsin Retirement Board, both kind of vestiges of the pre-1982 merger of the various retirement systems. Those are still around as advisory boards. And then we have the Wisconsin Deferred Compensation Board, which oversees Wisconsin's Section 457 deferred compensation program for public employees. As I mentioned, we're responsible for administering about a dozen or so fringe benefit programs. The WRS is obviously the largest one at about $4.5 billion per year in benefits. Group insurance, group health insurance, where we spend about $1.4 billion a year in health insurance premiums for state employees primarily. We have life insurance, deferred compensation, and employee reimbursement accounts, among other programs. So it's been a relatively quiet year for the WRS. 2015 was, and heading into 2016. As most of you know, the legislature has gone home for the year. There you go. Okay. So we wanted to touch on a couple of things that we might not ordinarily touch on, but will today. I'm going to bring you up to speed on what's going on with the annuity adjustments in the WRS and what we see coming down the road. But then we're going to talk a little bit, there's some good news that doesn't get talked about a lot that I'd like to cover, having to do with public employers in the Wisconsin retirement system and how the WRS kind of meets their needs in meeting their workforce challenges. And then I want to spend a few minutes at the end, not to depress you or anything, but just to talk a little bit about some of the challenges we see coming down the road for the WRS in the years ahead. And then Michael will be presenting, correct, Chris? Michael will be presenting. He is on his way. And then I think we'll have some time for questions and answers, or at least questions at the end of the presentation. So. Talk a little bit about the annuity adjustments. Most of you, you saw the announcement earlier this year that based on SWIB returns, the annuity adjustments will be as such, and those adjustments will apply to the April 1 payment that you get paid on May 1st of 2016. And for those of you in the core fund, which is all of you, that's a 0.5% adjustment. The decimal point is in the right place, unfortunately. But we'll work on that for years in the future. Of course, this is based on SWIB returns for this year and the rolling 5-year smoothing period. And Michael will talk a little bit more about the investment returns and what's going on in that horizon. So for those of you who want to do the math a little bit on the annuity adjustments, this chart essentially shows the actuarial math for this. It tells you up front, we have about 191,000 people who are in the core fund, retirees who receive benefits. The annual amount of core fund payments, about $4.3 billion. The fund balance, which is essentially the assets that are available for paying benefits, was about $49.1 billion at the close of 2015. The actuarial reserve, which is essentially the liability for the assets, the amount that we owe for benefits, was about $48.8 billion. And so when you do the math, when you have more assets than you have liabilities, we're allowed to pay an adjustment, a positive adjustment. When the liabilities exceed the assets, we're required to reduce those liabilities and take back some of the previously granted dividends. And so you can see the math works out to this year, it was a 0.05 adjustment. I often show this slide just because it kind of gives you a perspective of how the fund has done over time. And what this shows is essentially a hypothetical $1,000 annuity, both a core fund annuity and a variable fund annuity, for a retiree that retired in one of several years, 91, 96, 2001, 2006, and 2011. And it kind of shows you how that $1,000 hypothetical annuity would have done based on the annuity adjustments that we've provided over the years. And so you can see that somebody that retired, say, in 2011 in the core fund, that core annuity has grown to about $1,083, which is an annual rate of increase of about 1.6%, versus if you go way over to the right-hand side, a CPI inflation, consumer price index inflation of about 1.5%. So we've been fortunate to live in a fairly low inflation environment. If you go back to 1991, for example, that $1,000 annuity is now worth about $1,900, almost $2,000. So almost a doubling of that annuity over that time period. Annual rate of increase of about 2.8%, which exceeds inflation over that time period. And that measure is about 2.3%. So overall, pretty good growth. But it really, where you sit really depends on where you started in terms of your annuity adjustments over the years. And then, of course, you can see the far more volatile variable fund over time and how that's held up to inflation. I just wanted to kind of give you a sense of how core fund annuity adjustments have played out over time. For some of you who were here last year, I showed this chart as well. And the good news is, over the 33-year average of the WRS, we have been able to generate, through investment returns, an average annual increase in annuities of 4%, which I think is pretty remarkable. For retirement plans, defined benefit plans that have guaranteed cost of living increases, those guarantees are usually in the 2 to 3% range. We've been able to exceed that over a long period of time. Now, those of you with a keen eye or who are still awake at this point in the presentation will notice that the right-hand side of that chart is a little bit different than the left-hand side of that chart. Over the last 10 years, we've been able to generate an annuity adjustment of 0.6%, far below that long-term average. And of course, we know the main culprit of that, 2008, the financial crisis, we ended up with a pretty significant reduction in annuities over the next 5 years, which has not helped the average over time. I also want to point out that 1999 spike in the middle If you recall, that was the legislature's intervention in the WRS with Act 11, I believe it was, back in 1999, where the legislature essentially took a lot of the reserves that had built up over time and splashed them out to participants in the program. So we saw improvements in benefits, we saw improvements in annuities based on this, and we saw reductions in employer contributions and liabilities through that. And then shortly after that, we kind of fell off the cliff in terms of the investment markets and our ability to produce consistent returns like in the 80s and 90s. So one of the features of the WRS that you all know about is that in the core fund, your annuity can't go below the floor. And so what we've tried to do in this chart is kind of show you, of all the annuities that we're paying, how much is attributable to the base level of benefits that we can't reduce below, how much is attributable to annuity adjustments that have been provided over time, and then very little on here. There's some red on the top of those bars. That represents this year's annuity adjustment of the 0.5%. So the chart up in the corner just kind of shows you the math of that. After the end of last year, the initial annuity total liability was about $43 billion. Another $5.5 billion was attributable to the annuity adjustments that we have had over time. And then you add on about $200 million for this last year's increase. It means the total annuity liability is about $49 billion. And the annuity adjustment portion of that, the portion that can be adjusted downward if we need to, is about 11.7% of the total. So that just gives you a little bit of a snapshot. There's a spike here too in 2011. That's a different spike in terms of the retiree liability. Maybe some of you remember what happened in 2011. My memory tends to fade on that. But that's what that chart is about. So it shows very strong in terms of the initial annuity liability, and we're gradually building up those annuity adjustments again, so it's a larger and larger portion of that liability. So every year, we always try to give you a little bit of a preview of what's may happen in the years ahead. So we do some annuity projections for you. And this is kind of, this chart kind of shows the ground rules for that. We actually base this on actual investment returns all the way through 2015, and it includes returns from 2012 through 2015. Of course, 2016 will also be included in next year's annuity adjustment, but we don't know what the return will be at that point. The general rule is if we have a surplus, if we have more assets than we have liabilities, and it exceeds by 0.5%, we'll pay an annuity adjustment, and vice versa. If we have a deficit or if we have a liability that's larger than our assets by more than 0.5%, we'll reduce annuities. So we build in a load in this that represents the expenses of both ETF and SWIB, which is about 0.4%. And then we also build in a reserve of about 0.5% in the calculations that you'll see to account for longevity or mortality improvements over time. And we'll talk a little bit more about that later. But you should be aware that that's in here. And again, negative adjustments, should we have to impose them, can only reduce annuity adjustments that we've granted in the past. You can't fall below your original annuity amount in the core fund. So one other term that you should know, and I'll show you kind of some pictures of, is the market recognition account. This is the legal and scientific name for our 5-year smoothing mechanism. So it's intended to give recognition to kind of long-term changes in asset values. If we didn't have this, we would be seeing spikes in both contribution rates and annuity adjustments bouncing back and forth year after year. This helps us smooth that out. Investment gains generally that are equal to our assumed rate of return, long-term rate of return of 7.2%, are recognized in the year that they are earned. And the difference between the actual gains and losses in the assumed rate are spread over 5 years through this market recognition account. So that's what the account is. It's kind of how it works. It's a little more complicated than that, but that's kind of the Cliff Notes version. One less set of cautions as we go into this. These are really just projections based on what we know. We're not predicting this is going to happen. And only a true actuarial valuation can tell us what that annuity adjustment is going to be from year to year. This year is a good example of it. As I mentioned, one of the rules is we can't pay an annuity adjustment unless it exceeds 0.5%. This year, the math all worked out in terms of investment earnings over time that we knew we were going to be right around that 0.5% threshold. We just didn't know which side of that threshold we were going to be. Required the actuaries to actually go through and dig through the actual experience that occurred in the system to be able to tell us whether we were actually going to be able to pay a benefit, an annuity adjustment, or not this year. And then lastly, we're not trying to give you a precise calculation on what that precise number is going to be, but we are trying to give you a sense of the magnitude of the changes that we might be talking about in terms of future adjustments. So I guess the bottom line is don't go out and spend the money yet, and don't panic just yet either. So there's some critical information that we don't know yet that we'll have to fill in as we go along. So with that, I had just talked a little bit about the market recognition account. This is kind of the mathematical representation that's going on in that account right now. We have about $3.4 billion in investment losses in that account right now that we will be recognizing in future years. And so just kind of a cheat sheet to this chart. If the number is red, it's probably no good. And if the number is black, it is good. So as you see, what we were dealing with in 2015 for this last year, those are the gains and losses that the core fund experienced over time, smoothed out over a 5-year period. We had a couple of years that weren't so good and a couple of years that were pretty good. And they all netted out, and we were essentially dealing with the almost $800 million in red for 2015. But that's across the entire market recognition account. About 50% of that is attributable to the retiree reserve. Now for 2016, as we start the year, we're in relatively decent shape with about $150 million to the good in that account. And that's primarily because 2011 has now fallen off that 5-year smoothing. So what we don't know, though, is what is 2016 going to bring. We got 2 good years and 2 not so good years that we're trying to balance out to see what this year is going to bring. So that gives us a bit of cushion heading into 2016. But as you see, as you come out to the right-hand side of the chart, there are fewer years, and more of those years tend to be negatives. Now, some of you are asking, well, we only had a 4% or 0.4% loss in the core fund this year. How does that translate into or in 2015, how does that translate into $1.3 billion? We expected to earn 7.2%. The fund earned a negative 0.4%. While the absolute loss from 0 wasn't that great, still off from what we intended to earn. So that's where you end up with this. It's not a pure SWIB lost all this money. It's what we did earn didn't meet what we expected to earn over the long term. So that's what's sitting in the in the market recognition account, again, a little bit of good news heading into next year, or this year. So, I'll give you a couple of scenarios. If we hit our long-term assumed rate of return for this year of 7.2%, what will happen in the system? So you can see that if we hit 7.2% this year, 2016, we'll end up with an annuity adjustment, we think, of somewhere in the neighborhood of about 1.5%. That's fairly reasonable, especially in a low inflation environment. What we do is we kind of assume that we'll hit 7.2% every year. And if we do that, if we earn what we assume we're going to earn, when you look at these numbers down here at the bottom, there's not a lot of big positive numbers over there. And that's some of the headwinds we'll talk about a little bit later. But anyway, what you don't see is you don't see a lot of red on that chart, which I think is good. If we do a scenario where this year ends up flat, kind of like last year, so we end up right around the 0% mark. The good news, from my perspective, is that the annuity adjustment that we would be looking at for next year would be 0, as opposed to a negative number. And I think that's positive, and that's a testament to that little bit of a cushion that we have built up. However, if we go from the 0% and bounce back and hit our 7.2% assumed rate in the future, it still portends a little bit of struggle here on the annuity adjustments, where we might be looking at some modest negative annuity adjustments. Now, I'll point out that those are still relatively small negative adjustments. We're not talking about the 4, 5, 8, 9% that we saw after 2008. So still a little bit of stability there. We also like to do a scenario to just give you kind of a sense of the magnitude of what we need to see happening in order to generate a negative return. And based on our calculations, if the core fund had about a 3.8% loss, that would generate about a negative 0.5% annuity adjustment. So we would basically take back the 0.5% we gave you this year.
Bob, could I just ask a question on that?
Yep.
The series of graphs. No, the next one, please. Yeah, that 2.9% in the lower left-hand corner, how does that relate to the 0.5% that we're actually getting?
It doesn't. That's actually an error. Thank you for pointing that out. That was a 0.5%.
Yeah, it should be 0.5%.
So send back the 2.4% that we're sending you in May. No, I'm sorry. That's a typo. Sorry about that. Everything else, I think, works out. Good catch. So you pulled us back from the precipice of having good news. So that was good. So the negative news again, what would happen? And then the thing I want to call your attention to is these out years, the negative adjustments if we see a loss this year. Again, the message is these are just projections. I think Michael will talk on this a little bit later, but the serious negative returns that we were seeing earlier this year seem to have abated a little bit. I think currently the core fund is somewhere right around 2% on the positive side for the year. So again, that gives us a little bit of hope as we move forward throughout the year. No time to panic. We just want you to be aware so that you have a heads up on what may happen in future years. So I mentioned that we might talk a little bit about some good news, and this might be a little stealthy good news, but I think it's good news nonetheless. Usually when we talk about pensions, we talk about benefits, like we just did. How much am I getting? You know, what's the amount going to be? How much am I going to get when I retire? Those sorts of questions. But one of the things that we often forget is the importance of pensions in helping employers attract and retain the type of workforce they need to have quality services for people in the state of Wisconsin. And the framers of the WRS were pretty insightful in their approach to this. This is just a piece of Chapter 40, which is the statute that sets up the WRS. And it's got some pretty powerful language in it, I think, about what the purpose of the WRS is. And if you just take a minute to look at that, promoting economy and efficiency in public service by facilitating the attraction and retention of competent employees, by enhancing employee morale, by providing for the orderly and humane departure from service of employees no longer able to perform their duties, et cetera, et cetera. That's the purpose, one of the main purposes of the WRS. And that often gets lost in the discussions about pension reform and things like that. It's usually about the math. It's not about the purpose of the WRS. So I want us to keep that in mind as we go forward. So who are the employers that we have in the WRS? Presently, we have about 1,475, 1,480 employers that participate in the WRS. 260,000 active employees. 27% roughly of those are state employees, state and university employees, and about 73% are local employees, local government employees, school districts, cities, towns, counties. Really the only major employers, public employers in the state that don't participate in the WRS, the city and the county of Milwaukee that have their own pension systems. Another thing that we don't pay a lot of attention to is kind of the gender makeup of participants in the WRS. Over 60% of our participants are women, which is and about 37% are males, and that'll come into play a little bit later here. In 2014, employers paid about $1 billion in WRS contributions, employers around the state. Employee share of that was about $900 million, and that's on a covered payroll of about $13.2 billion. So the total payroll of public employees participating in the WRS is about $13.2 billion. Current contribution rate for the WRS is about 13.2% of total payroll. Our 10 largest employers, the state of Wisconsin is the largest at 73,000 employees. That includes the UW system. So while the majority of employees are local government employees, our largest employer is the state. And then you can see Milwaukee Public Schools, Madison, Green Bay, a lot of school districts are large and are leading employers. City of Madison, Milwaukee Area Technical College, Dane County make up the 10 largest employers. And that list has remained fairly consistent over time. They have some shifting in their relative order, but the top players are still there. So with those contribution rates and that $1 billion that employers are paying, that must be eating up the vast majority of local budgets if you listen to some commenters. This is an interesting statistic that the National Association of State Retirement Administrators pulls together for us from census data. And it essentially demonstrates that state and local spending on public pensions on aggregate is about 4.1% of their total direct spending. That number for Wisconsin is less than 2%. And that's paying the full share of what's required to be paid in Wisconsin, which Wisconsin has done a very good job at. Some of our neighboring states don't pay everything that's due, and it still takes up 4.1% of their operating budgets. So I think that's good news, and that's kind of a good story we can tell. It's a very, very small share of general government operating. So do public pensions matter in terms of recruitment and retention? Don't have any real good statistics on recruitment, but on the retention front, I recognize that there are a lot of differences between the public sector and the private sector, but one of the big differences is the makeup in the benefit structure. And this chart just kind of shows the tenure trends among public employers in the public sector versus the private sector. And what this demonstrates is that the public sector has far better tenure trends, almost double what the tenure trend is for the private sector. Is that all due to the availability of pensions in the public sector? No, probably not, but I suspect it has something to do with it. But that's interesting information, I think, to keep in mind. So how important are pensions? So the National Institute on Retirement Security is an organization in Washington, D.C. that spends a lot of time doing a lot of research on both retirement adequacy, retirement trends, things generally affecting retirement. They find that women in general are 80% more likely than men to be impoverished at age 65. Women between the ages of 75 to 79 are 3 times more likely than men to be living in poverty. And interestingly, they find that women in healthcare, education, and public administration fields, where defined benefit pension plans are more common, have higher incomes in retirement and lower rates of poverty than other industries. I think that's something important that we need to keep in mind. And in fact, unlike much of what we hear perhaps in the press, NERS found that Americans in general have a highly favorable view of pensions and are more likely to choose employers that offer a pension rather than a 401k plan. That certainly doesn't apply to everyone, does it? We don't know. But interestingly, the same survey that NERS did found that even millennials have an overwhelmingly favorable view of defined benefit pension plans. So when we look at kind of the workforce of tomorrow, the workforce of today, there's a clear case to be made that defined benefit pension plans like the WRS are serving to meet the needs of public employers, especially here in Wisconsin. Now, the one bit of good news that I wanted to share on this front actually emanates from the legislature this year. The one piece of legislation that actually passed, 2015 Wisconsin Act 174, passed the legislature and was signed into law by the governor. It allows employers to elect employers who in the past have not chosen to come into the WRS. It allows them to choose to come in and bring in new employees only. And what this does is it makes it a little bit easier for employers to join the WRS. The past rule was that if you came into the WRS, you had to enroll all of your employees, your new ones, the ones who had been here for a long time. Many local units of government were finding that expensive, and they couldn't do it. But one of the other things they were encountering, some of these municipalities, and Sun Prairie was a good example of this, they were having trouble recruiting city managers from other municipalities to come and work for them because Sun Prairie's city government does not participate in the WRS. And they would find a candidate that they would be interested in, and the candidate would say, well, I'm covered by the WRS, I want to stay covered by the WRS. So the takeaway from this, for me, is that the legislature in this current climate still sees the value in the WRS in meeting government employer needs in attracting and retaining qualified public employees. I'm taking this as a victory. You can take it any way you want, but I think this is good when they're talking about how valuable the WRS is for public employers in the state. So no talk of mine would be complete without mentioning a few challenges. A couple of things I want to keep your attention focused on. I talked a little bit on some of those charts about the annuity adjustment grounds coming up, and I want to talk a little bit more about that and a couple of the drivers of that. But first, I wanted to share some magic pension math with you, because this is kind of the formula that makes everything happen. So C plus I equals B plus E. So contributions plus investments have to equal your benefits plus your expenses. It's just kind of the base level formula that we use in the pension world. So when you think of this, if your investments go way up, you have a very good investment year, well, then you can do a couple of things. You can adjust the other side of the formula and increase benefits. Or you can go and you can reduce the contributions a little bit. And that's typically what Wisconsin has done. So I'll come back to this a little bit, but hopefully if you can commit this to memory, or at least put it in there somewhere, you'll start seeing where the concern comes in coming down the road. Michael is going to spend some more time, I think, talking about this current investment environment that we're in. We kind of refer to it as a low return environment. We've kind of seen the stock market just kind of sidestep along here for a few years. Quite a bit of volatility, but we're not seeing the high returns. And so when your investment side of that equation tends to be a little bit lower, we know it has an effect on the pension system. We either need to change the C, the contributions, or we need to adjust the B, the benefits. And so in the WRS, when we have the cost sharing, the risk sharing component of it, my point is you're probably going to see for the next several years a dispersion of annuity adjustments annually that look more like the right side of this chart than the left side of that chart. On the employee side, it probably means that we're going to start seeing an uptick in contribution rates. Not a lot. Again, we're not bleeding money. But as investment returns are somewhat muted, it's going to put pressure on those contribution rates, on the C part of the equation. If they don't want to increase contribution rates, the other thing they can adjust is the benefit piece of it, because that's the other big piece of the equation. And so as contribution rates start going up, we've seen this in other states. We saw it here in Wisconsin over the last several years. Legislators start looking at ways to reduce the liabilities and the costs of the system through benefit changes. So don't be surprised if you see that. The last several years, we've still been able to manage reductions in the overall contribution rate, and we'll be sending that message certainly to the legislature when they talk about these issues. But just, keep this in mind as the investment environment continues to chug along at a low rate. There may be some consequences in other parts of the system. The other issue I want to call to your attention is kind of a good news, bad news sort of thing. The good news is you're all living longer. The bad news is you're all living longer. What that, of course, means is that it costs more to fund those benefits over an extended lifetime. What our actuaries are telling us is that WRS members, on average, are living longer than compared to most of our peer systems, and as compared to the current actuarial tables that are in existence for Social Security and things like that. So again, all very good news. Everybody wants to live longer, but we need to find ways to pay for that extended life. And we do that a couple of different ways in the WRS. For active employees who are going to be living longer over both their career and their retired career, we build in some weighting into the contribution rate so that employers and employees are paying for that extended longevity, which is a good thing. It's not large. It's a small increase to recognize that. And then on the retiree side, we also build in a small charge into the annuity calculation each year. So for about the last several years, that calculation has ranged anywhere from about 0.3 to 0.5% when we're calculating the annuities. So we essentially hold back somewhere between 0.3 and 0.5% in order to pay for the extended life of the annuities going forward. After our latest experience study, where we have the actuary actually dig into the numbers and look at the experience that's going on in the system, they recommended, and the ETF board approved, changing that holdback to 0.5. So it's 0.5 going forward for the next several years. So that's a little bit of a holdback, a little bit of a headwind in terms of those annuity adjustments, but it helps us keep the benefits and the funding for those benefits intact going forward. So again, these are put out here as something for you to keep your eyes on. We don't want surprises when we get to annuity adjustments next year or anything else, and then we end up getting a bunch of phone calls, people not knowing what's going on. So in the spirit of no surprises, we give this information to you. Again, we don't want you to panic about it. We just want you to be knowledgeable users of the WRS so that you can see what's going on. You can do some planning if you need to do that. Again, WRS remains one of the best funded pension systems in the country. We're in a strong position. We'll be able to pay benefits for many, many years. There's not a lot wrong with it, but we're running into some things that will just make the next few years a little bit of a challenge. We'll continue to give you information. We'll continue to work with you so that you understand what's happening. And we'll continue to manage the WRS as we have in the past. We've got a great track record, and we hope to keep that going in the future. So with that, if you do want to stay connected with us, we got some information for you up here. We'd like you to keep your eyes open as well for our Facebook page, which we should be bringing online sometime in the next few months. But if you like to tweet, you can do that. I don't know what that is, but it's apparently fun and is all the rage in presidential politics. So with that, I'm going to end my remarks. Michael is here, and I think we'll have a couple-minute break so that we can change, and then we'll save questions to the end. Is that how we want to do it? All right, so thank you.
Our second speaker is Michael Williamson, who's the Executive Director for the State of Wisconsin Investment Board. And during his time in Madison, he was assistant to the UW-Madison Chancellor, policy advisor for the Office of the Governor, and chief of staff in the City of the Madison Mayor's Office. And I know that he became experienced in shoveling snow when he lived in Madison the first time. Back this time, he moved into a condo. He has a bachelor and master's degree in public administration from the University of North Carolina at Chapel Hill. So with that, Michael, give us the good news about investments.
Thank you, ma'am. Can you hear me okay? I feel like I'm wired for the CIA or something. I've got one for the video, I got one for the audio, I got the podium up here. I feel like I'm at a White House press conference. Yeah, you know, that's what happens when you're a Southerner and you move to Wisconsin. You buy a corner lot. And you don't understand that you have to shovel it after it snows. It was 250 linear feet. It was a lot and a half. And I had no garage and no basement, so I had no snowblower for 14 years. She's correct. I live in a condo now, and I don't even own a shovel anymore. So I am trainable. The next thing that I want to say is when you come to this place, you need to pack your lunch. One of your members, I parked up on the hill, I think next to the research farm up there, to the research park, and walked down here, and I ran into one of your members, and we weren't exactly sure where we were coming or how long it was going to take, but it's quite a pull to get down in here. But along the way, we talked about I asked her where she worked. And she said, well, she'd worked for the state agency, and then she'd worked for the city for a while, and then she'd worked for the university. I said, well, I work for the state, and I work for the city, and I work for the university, and I used to consider that to be employment diversity. My ex-wife referred to it as I couldn't hold a job. So, but we both had worked in lots of the same organizations, and I was, Donna Shalala was in town last weekend. I don't know if any of you had a chance to see that in the press but I spent some time with her on Thursday night, and she's just as enchanting and interesting as she was when I worked for her, which has been 15, 20 years ago. But just fascinating woman, now working for the Clinton Foundation and running that. She'd retired out of the University of Miami, but just fascinating to catch up with her. I do want to say one thing about bobslides. And you notice that mortality study stuff that he had up there. And he's got half of a basis point he takes out of my earnings every year and sets aside to pay for you folks getting older. We had the same problem in North Carolina when I ran the system down there, and so I introduced a program that encouraged drinking, smoking, and running around. Up here, it would have an additional component be called fried cheese curds. So what I want to talk to you about today, a little bit, I'll talk about some of the returns. You've seen some of that. I'll take a little longer view on the returns. Talk about the immediate ones from last year. Talk a little bit about our investment strategy. I'll talk more about this low return environment. In fact, I'm going to show you some slides of 3 different decades and what has happened in the economy for 30 years now. Because people, and a fellow came up to me just a minute ago and had a question about, well, we used to get better returns and stuff, and now is this related to all these ETFs and these index funds? And I said, no, that's just a different vehicle for people to invest, and in fact invest for a lot lower fees than what you would have traditionally paid if you hired a financial manager to help you out or a broker. So you can invest in these stocks, but I'm going to show you a little bit about what I think has occurred over the last 30 years and why this is a difficult environment. I'm going to talk to you a little bit about our strategy to managing that, particularly after 2008. And then I'm going to talk a little bit about the cost stuff and about how we're trying to cut costs as well. And you'll hear me say it later, but $1 saved is the same as $1 earned. You've heard it hundreds of times. And any dollar that we can save is as good as one that we make off a return. So we've done very well in that regard. So let me get started here and talk with you a little bit about just kind of what's been going on. The stock market last year was the most difficult stock market since 2008. It was a difficult year. It had poor performance, and contributing to that rough year were things like the drop in oil price, which very few people anticipated. It was good for all of us because we got cheaper gas prices. But then you had the soft economic growth and the currency devaluation that occurred in China. You had the uncertainty around the Federal Reserve's decision to raise interest rates. And that all contributed to a very difficult time last year. And that's what many economists are calling this low return environment that you heard Bob talk about as well. And it was certainly the case for the Wisconsin retirement system, the trust funds. So here you see what the return, you heard Bob talk about, we basically refer to it as being flat. That sounds a whole lot better than a negative 40 basis points. And remember, it's 100 basis points makes 1%. So a 0.4% negative or 40 basis points negative. But the reality is the 3, the 5, and 10-year periods still remain positive and are ahead of our benchmarks. And I use a benchmark, I talk about a benchmark, it's just a way to compare performance. It's a way the trustees measure our performance. It's the way our staff measures the performance. It's just a set of comparable investment instruments that we compare to in the marketplace to see whether we're doing better or not as good as those benchmarks. So the last year also had an impact upon the variable fund. You can see it was a negative 1.2%. But once again, the 3, 5, and 10-year returns are strong, and they are above their benchmarks as well. But let's go back to the core trust fund and dig a little deeper to see exactly kind of what happened in there last year. So you can see from this slide that we had a couple of asset classes that generated very strong experience. Real estate and private equities were the two best. And our compensation is tied to that performance. If some of you might have seen, we made the paper Saturday. We make the paper at least once a year. And that's when the trustees give out the incentive compensation. But if you notice, the highest earner was the head of our private markets group that had real estate in it. And I'm going to show you just so you can see it was actually very strong. Real estate 14.9 was the benchmark, but our return 16.1%. Now there was a time in 07, 08, 09 when real estate wasn't doing as well, and consequently their incentive compensation was minuscule. But they're doing really good, and that's the way the plan is designed to move forward. That's why we diversify our investments, because you're not going to have everything hitting it out of the ballpark at the same time. Let's talk a little bit about that. I told you the 16.1. You can see the 3 years 15.7, the 5 years 16.7, and the 10 years 7.4. That's where you see the 07, 08, 09 returns starting to creep back in there. But the most recently, they've done really well. We use real estate to help us reduce volatility, to create more consistency in returns. A lot of our real estate investments pay rent. And so we have income that comes in all the time. This is not all just on speculation of buying something and then trying to sell that. And approximately 7% of the core fund is invested in our real estate portfolio. It includes offices, retail buildings, apartments, industrial and warehouse properties, as well as hotels. We did sell 2 properties last year. Valuations, or how much the property is being valued at, had just increased so much recently that it didn't make sense for us to hold on to one of them, and the other one they didn't give us an option to hold on. The first one is the Nike Town store down on the Magnificent Mile in Chicago. We owned 3 buildings there, but the biggest tenant was Nike Town. They've been there, we've owned it since '91. We sold that, a foreign investor bought that. A lot of money's coming into the U.S. because it's a safe haven. And so the prices went up so much that we did sell it. The other one was the Facebook campus. Many people don't know this, but we owned the Facebook campus for the past 5 years. They were getting ready to go out for their public offering. They didn't want that liability showing up on the books. They came to us, we did a single deal on it. We were the only investor. We bought that campus, we held it for 5 years. They had an option to renew, and wisely they bought it back from us at the end of that 5-year period of time. So we ended up selling the Facebook campus, but we generated almost double-digit rent returns off of that for those 5 years. So that was a great investment for us. So let's talk a little bit about private equity. That's the other piece that's done well. You can see that it had 10.4% in 15, and you can see the 3, 5, and 10-year returns for that. It's performed well for us over the long term. But one area that did not perform very well for us last year was public equities, or stocks, which have been extremely volatile. I've spoken to you in the past about our strategy to reduce the core fund dependency on the stock market. 85% of our risk is in the stock market. And we noticed that, you saw that particularly true in 2008, when the stock market was down 40% in this country. Ours was down only 26% because of the diversification, but since then we have moved. So we had a high of about 56%. We're down below 50% in terms of stocks right now. One of the things, and it wasn't just the U.S. stock market had a rough year last year, but it did better than a lot of the stock markets around the world. And if you start peeling it back a little bit under there, you'll see that about 18 stocks accounted for 50% of the returns last year. And there's a new acronym that's out now. They're talking about FANG. So it's Facebook, Amazon, Netflix, and Google. And these are real growth stocks. They can provide significant returns, but many of them are volatile, and they also experience severe price declines. We consider ourselves to be value stock investors. So what we do is we estimate the value of a stock or a company based upon their performance, their leadership team, the potential market increase. We assess a price for that. When the price gets below that, we buy that stock, and when the price gets above it, we sell. With these FANG stocks, with these new growth momentum stocks that they're calling about, they just surge quickly, but they can also come down quickly. But that's where the stock market did good last year. And these companies, when we use this value investing approach, we do a lot of research on that. We put a lot of effort into understanding the companies, visiting with them, and trying to make educated decisions. And quite frankly, that's what you pay us to do. We don't just invest in the greatest, hottest, flashiest thing. We have a value-based investment program that we use. But the markets are in many respects changing. While we were glad to see 2015 go, 2016 came in, made me wish 2015 was back again. January was really a tough month in the stock market. And many of the changes that we saw in the markets in 2015 we're seeing carry over to 2016. And we saw in the beginning of the year the markets continue to be volatile, and that indicates this low return environment. It's not going to be impossible to make money, but it's much more difficult, and I'll show you that in just a few minutes. We believe we're going to see returns similar to what we've seen going forward, experienced in the past few years, rather than in the 80s and 90s. There was a lot of, some of you might remember the variable fund got closed, and you couldn't get new people going into the variable fund. But in the 90s, the stock market was going crazy, and people said, we're getting deprived. You're keeping us out of the stock market. We want to put our money in the stock market and make these high returns. And I think that happened in about 99. And then something happened in 2000. Right? So, the variable is a interesting place. If you like excitement in your life, the variable is where you ought to be. Because it goes up and down. If you look at the returns, the long-term returns over 20, 25 years, the core and the variable about the same. But you don't get the excitement of having 26 return and 40 loss, So that's, but unfortunately they introduced the variable again, opened it back up just at the time that the market went down 2000, 2001, 2002. So, what they say, it's not very likely to time the market. And once again, that proved to be the case. So when it comes to investing money, there's a great deal of risk, and that's why we've implemented a strategy that protects the trust funds, or attempts to anyway. The market downturn in 2008 and the Great Recession changed our outlook on risk, as it did many of the people in financial investments and economic interests around the world. So we're focused in risk because the WRS is unique in that you folks share that investment risk. You know that. I don't have to tell you that. You went through the 09, 10, 11, 12 reductions that Bob had referenced earlier. The struggle is trying to find the right balance between being cautious enough to protect the fund while being aggressive enough to allow it to continue to grow in order to pay out this benefit. You know that you can see from Bob's numbers that we're in a negative retirement. We're paying out more money than we're taking in contributions every year. And that happens in a mature plan. That's not a problem. That's the way mature plans work. So that means that we got to have at least some level of investment returns going into that as well. So how do we manage this risk? Well, let's talk about it just a minute. We manage it both short-term and long-term. It's core to our work. It's a central piece of it. And the primary tool that we use is diversification. As I said earlier, 85% of our risk that we deal with comes from the stock market. So we've been taking steps to lessen that by reducing the percentage of the fund that stocks make up. And one key to managing risk in the core fund is to have a diverse collection of assets: stocks, bonds, real estate, fixed income, hedge funds, and other classes. So we're constantly working to develop an asset allocation strategy that matches the changing investment environment. For example, we're continuing to build work now on our newest strategy, which is multi-asset. So rather than stocks and bonds, we try to pull the best ideas from our managers, from our investors in-house, and put them into what's called the central book. If you look at running a hedge fund, there's a central book, and the managers, the hedge fund, take the best ideas out of each portfolio and put them in the central book. Because sometimes the portfolios are limited about how much of a percentage they can get. We try to take those best ideas, and that's our newest strategy. So, what does the work we're doing in managing risk mean for the retirement funds? So some of you have seen this chart. I use it regularly. I show it as many times as I can. It's theoretical. It's not based on any data. But what it's doing is it's showing with the blue line that's up here what the market might theoretically do, and the dotted line is what the SWIB investments do. And our strategy is designed so when the market is raging and it's going really hot, we don't have as high a return. So you can compare us to the S&P 500, and we get calls. Chris is here with me. He works on our communication staff, and he's the front line when the calls come in. But we get calls and say, well, the S&P did this last year, and you guys only did this. How come you're not? Well, the reason is we have diversification. But the goal is whenever the market drops, like it does from time to time, let's say January, we don't go down as far. And that's the whole essence of the strategy that we've been working on. And so you'll rarely see us match the market returns. Every now and then we'll be crossing lines and we'll be at the same point, but rarely is that, but that's intentional. And the question then becomes, is it working? Well, let me just give you an example. Start of 2016, I told you, was really rough. At the end of February, the core refund had a return of a negative 2.5%. And as you can see here, the S&P 500 was down 5%. The Russell 3000, which is an index fund of the 3,000 largest companies in the country, was down 5.7%, and the world index, with minusing U.S. equities in there, was down 8.6%. So I don't like minus 2.5, but I like it a lot better than minus 8.6. And that's exactly what the strategy is intended to do. Now, I was looking at the returns through Friday, last week, this morning before I came over here. And the core fund is now standing at 3.19. That's a plus 3.19. I have to add that. Used to, I didn't have to put that in there, but now I have to add that. It's a plus 3.19. The variable's at plus 2.12, and the S&P is at 2.47. So the core fund is beating the S&P 500, even, and it's over, it's over 1,800 now. So, the core fund, the strategy, I think, is working. So, this is not the first time we've had to deal with market fluctuations, but so let's go back and look at the 20-year returns, and this is the point I was referencing earlier. 7.5% for the core fund, 7.5% for the variable fund. It just depends on how much sleep you like to get with the variable fund. You can go to bed knowing the core fund is going to be balanced and invested, diversified. But with the variable fund, you never know when you wake up what's going to happen there. So that's a good returns for us. Let me talk also a little bit about the 3 decades that I told you about earlier. So if you were to ask me and say, what's happened over the last 30 years, I would show you this chart. Now, I know the print's a little small for you, so let me walk you through this. On the left-hand side, you have returns. And across the bottom, you have risk. And you got a blue line there, which is our assumed rate of return. Now, many of you know that's 7.2% now, but for many years it was 7.8%. And then the ETF board reduced it down to 7.2. So people say to me, well, now, isn't 7.2 too high? Well, it's all relative. But compared to our other public pension plans, we're on a more conservative base. The DC retirement system's at 6.75. But a lot of them are still at 7 3/4. Some are still at 8. But the ETF board took the conservative approach several years ago to reduce it to 7.2, and I think that's a good piece. Now, the red line across there is just what the assumption is when you take the money when somebody retires, what we have to earn, which is about 5.5%. So even though we have the 7.2, really what's assumed when they take the money from your active account and Bob moves it over to your retired account, the assumption is we're going to earn 5% every year going forward. So that's really what we have to earn, but we want to earn the 7.2 or better. So, and you can see there's several things on here. There's cash, there's treasuries, the core trust fund is marked, the R3000 is that Russell 3000 that I talked to you before, and the MSCI World is world stocks. And you can see how they did over the 30 years. And you can see the core trust fund was earning roughly 9%, about the same, a little bit less than the stock market at the Russell 3000. But look at the difference in risk. The stock market is much further over to the right, and the world stock market, the world index, is even further to the right. So we're earning about the same interest rate over that 30-year period of time. Let's break it down by decade. All right, this is October of 85 to September of 95. 10-year period. There were shocks. You know, people think, well, we're just programmed now to think about, well, the Great Recession and what. But there's been financial shocks in every decade that we've had. And they've caused the market to fluctuate. So in this particular decade, we had 87 market crash, the savings and loan crisis, and the Gulf War. But you can see, you know, cash is paying almost 6%. Look at treasuries. If we'd have bought 30-year treasuries and held on to them, we'd have been golden. Look at that, almost 10% on treasury. The core trust fund is earning over 12%. Stocks are up almost to 16%. And so things were rocking. This is a decade when things were cooking. All right, let's go look at the next one and see what happens there. Now this is 95 to 2005. The shocks were the Asian financial crisis, the 98 Russian financial crisis, the tech bubble was in this decade, 9/11, and the Iraq and Afghani wars were in here. So, you know, these were rocking the financial scenes as well, but things are still doing good. The core trust fund is up there around 9%. U.S. stocks are down close to the same, but still more risky. Cash is paying a little less than 4%, and treasuries are paying more than 6%. Let me show you the next decade. You can see the trend that's coming. All right, this is 2005 to current. So this is our current 10 years. We've got the 2008 market downturn, the Great Recession, the European debt crisis, and the Middle East turmoil. The core funds only slightly trailed U.S. stocks and was ahead of world stocks. But look how the returns on treasuries and cash have dropped to virtually nothing. Remember how you used to have a passbook savings account? And remember what they used to pay on that? 5%. You looked at your savings account lately? Your checking account, you're getting virtually nothing on it. And if you're in Europe, you have to pay money to keep it in the bank. They have negative interest rates. Japan's the same way. You have to pay to keep it in there. They want you to take it out and spend it so they can get the economy going. So what's happened is this federal monetary, and now it's an international monetary policy, has suppressed rates and made it extremely difficult to generate return. You can see on this chart, even though we're relatively close to the stock market, but look how low everything has gotten. And that's the low return environment that Bob was talking about. So let's take a look forward. Now I'd like to be more optimistic than Bob was, but it's difficult, at least in the short term. But you got to remember, we're long-term investors. We're looking 30, 40, 50 years as how the retirement system is funded. But the reality is the returns that we're going to be expecting in the next couple of years are going to look a whole lot more like they have in the last few years, or at least that's the prediction. And some of you have heard me say before, if I could predict the future, I wouldn't be working for the state. But when we talk to our asset allocation consultants, we talk to the actuaries, there's pretty much consensus that we're in this low return environment. And what our asset allocation consultants predict is we'll probably be in the neighborhood of 6.1% going forward. Now we have some active strategies with our internal hedge funds and some of our alpha plays that we're working on that we think will generate 40, 50, 60 basis points on top of that. So we're 6.5, 6.7, 6.8. We're getting close to the 7.2 that you saw Bob have up in his projections, but it's doubtful that we'll probably make the 7.2 in the next couple of years. It's just, you can see we've got to have the Fed start raising interest rates so the bond market is really flat. It's just, there's no place to really hide out there and generate money unless you want to play a lot of risk. And quite frankly, we're not going to do that with your money. It's not worth it. We're too well funded. We have too good of a plan designed to be swinging for the fences to try to make up those gaps. And if we just stay steady, keep our nose to the stone, keep working on innovative investment strategies, we believe this will turn out for the good as we go forward. Because we think we'll make that 7.2 over the long term. And, as I said before, the WRS will remain fully funded. So it's important to remember, in addition to our investment strategies, we've also put in other initiatives that had a significant positive financial impact on the system. I talked to you earlier about the dollar being saved is a dollar earned. We continue to be a low-cost public pension fund. Compared to our peers, we bring in external consultants. They compare our costs. We've made a decision as part of our investment strategy to invest in fewer high-cost assets, such as private markets and hedge funds, which has generated a savings of $144 million last year compared to our peers. And as important as the types of investments, it's also how we invest those that makes a difference. And we've managed more money internally and passively. And what that does is we negotiate lower external fees with those external managers that we use. And that's generated an additional $63 million in terms of savings last year. Our total budget is only $49 million. And one of the ways we've done that is we've gone to internal management. In 2007, we were managing roughly 21% of the money in-house. The rest we were paying external managers. Now we're managing 66% of that money in-house. Now why does that make a difference? It costs us 5 times as much to manage it externally as it does to manage it internally. Now when you see that article with $11.1 million in incentive compensation, you think, wow, that's a lot of money. And it is a lot of money. But as I said in the paper, we're in a war for talent. And our goal, when you're paying somebody else to manage your money, they got to have the talent. But when you're managing it in-house, we need the talent. And that compensation policy has allowed us to attract and retain very skilled investment professionals. Madison is not the easiest place to attract investment professionals. If you're in New York or San Francisco and you're thinking about making a job change, you don't look to see what kind of job openings are open in Madison, Wisconsin. But Madison is not the toughest place to do that for 3 reasons. Number one, we have competitive salaries. And our salaries are not benchmarked to the East and West Coast. The trustees have picked a benchmark that's tied to insurance companies, banks, and in-house investment shops. So what does American Family pay its investment staff? And we don't try to be at the top of that. We just want to be at the median of that. So that's good. We got competitive pay. Number two is you don't have to give up your professional goals. You can come here and work on some of the most complex investment strategies you can find anywhere in the country. So you can still be at the top of your game and work for the State of Wisconsin Investment Board. And number three, we have a secret sauce. Now, I'm being recorded, or I'd tell you the secret sauce. But I'm going to do it anyway. Almost everybody that we hire is either born in the Midwest, went to school in the Midwest, or married somebody in the Midwest, or has a significant other. They got some connection to it. And they understand that if you can get through the winters here, you got a pretty good life. We try not to recruit in January. But most of the people understand what winter's like here, and you have to hunker down to get through it. But then you have, look at what we've had the last few days. It's glorious. You know, and but they've got some connection to the Midwest, and they're tired of living the rat race on the coast, or they want to get back here, they've got family here, and those people come in and we're able to keep them because of the compensation plan that we've got. So I think the system's working. We're able to save money. We spend money. And you know, what does that generate? Well, the last 5 years it's generated $1.2 billion above what the market would have returned. The incentive compensation for the last 5 years is $49 million added together. You take that 11.1 this year, you add it together, that's a lot of money. When the average public employee makes $42,000, the average retiree's making $25,000, and you see people that's getting 6 figures for incentive compensation. But folks, I'll invest $49 million to get $1.2 billion any day, all day long. And that's the way I think we have to look at it. You get what you pay for. So I've got some contact information up here. I'm gonna close with one story, and I want to do a disclaimer up front. I'm a registered independent. Nobody knows how I vote, and haven't for 2 decades now. My children don't even know how I vote, so I don't have a dog in this fight. But there's a small plane flying along. It's at 20,000 feet, and the door comes open, and the pilot says, "We've got a problem with the dashboard is on fire. We're going to have to jump to safety." And he said, "But there's a problem." He said, "There's 4 of us on this plane, and there's only 3 parachutes." And he said, "I'm the pilot. I'm going to take one and jump to safety." So he puts it on, opens the door, and jumps out. Well, there's 3 people left. There's a Catholic priest, a Boy Scout, and the Trump. And Donald jumps up and said, "You know, my plane had technical issues. I had to fly this thing. I knew it was a bad idea. I could potentially I am going to be the next president of the United States, and I'm probably the smartest guy in this country. I'm going to take a parachute. It'd be a travesty if I went down with the plane. I'm going to take one." So he puts one on and he jumps out. Well, that just leaves the priest and the Boy Scout. And the priest turns to the Boy Scout. He puts his arm around him and he says, "Son, the Lord's been good to me. I've lived a good life. I've made contributions. People have contributed to me. It would be a travesty if the plane went down and you were on it because you have your life in front of you. You should take the last parachute. I'll go down with the plane." The Boy Scout takes his arm, puts it around the priest, and he said, "That's all right, Father. The smartest man in the country just grabbed my knapsack and jumped out the airplane." So what I don't want you to think is that our retirement system is a knapsack. It's a parachute. But you know, it's going to be a rough landing here the next couple of years, but stick with us. We're going to come through this. Things will come out of this. We still got the best funded pension plan in the country. I think we got a strong design, and I know people have fears that the administration or the legislature has got designs on it. I don't see any indication of that. Bob told you the only positive story that we've seen so far in terms of the change that came out of there. I think we're setting good. Somebody said to me the other day, well, you know, Walker was running for governor and he was out there and he was trying to take credit for all this stuff. And I said, that's good. You want him to take credit for that. Because the more he owns that and feels attached to that, the less likely he is to mess with it or let legislators mess with it. So I think we're in a good spot. You know, I'd love to be in here telling you we got double-digit returns. And I'd love to see that happen. We've made a big play in Europe. We got rid of our home bias. We split our stocks. We're 50% U.S., 50% on the world. We think that the world market's going to turn around and the European market's going to do better this year, and we're going to do better than our benchmark. But you know, being early sometimes looks a whole lot like being wrong. And we've been a little early on this one. But that's just the nature of the business that we're in. We're going to continue to do the best we can for you, and we appreciate your support. And Bob and I will be happy to answer any questions. You can give the tough ones to him, and I'll take the easy ones.